Welcome to The Money Huddle, a podcast that explores financial topics for families and small business owners. Hosted by Michael Baker and Ross Marinell. All opinions expressed by Michael and Ross or any podcast guests are solely their own opinions and may not reflect the opinions of Planners Alliance. The podcast recording is for informational purposes only and should not be relied upon for investment decisions. Clients of Planners Alliance may maintain positions in securities discussed on the program.
Welcome back to the Money Huddle. My name is Michael Baker, and I'm here with my co-host, the man, Ross Marinell. Ross, what's up, buddy?
Hey, Michael. It's good to be back on the podcast with you, buddy. How you been?
So what's happening? What's been the latest? I know that you guys have been doing some traveling this summer. Have you guys been anywhere fun?
So we just got back from a short trip to Lake Tillery. Which is kind of out by Albemarle. Never been out there before. Really cool. Had a good weekend. Got our little kids on the boat, and our 7-year-old's like, "Can we do this every day?"
Of course.
So not yet, nope. But it's fun. So man, 2020 has been wild. Obviously, I wanted to kick something off today. Saw this come through around, I think it was like the middle of July, like July 10th, somewhere around there, that Elon Musk traded spaces with Warren Buffett on the net worth list. Did you see that come through?
I did see something like a little blurb about it with Tesla's valuation just going through to the moon.
So this is on NBC News. So Tesla CEO Elon Musk is now the 7th richest person in the world, surpassing legendary investor Warren Buffett as Tesla's stock continues to skyrocket. All right, now if that is not a perfect summation of what's happened in the market in 2020, what else is?
I can't think of one. It shows how the market loves ideas, even if they may not be the most viable, but just the idea of what the future could be. The market can fall in love with it and just decide that, you are the company of the future. And it looks to be like that's what's happening with Tesla. Another thing that is part of this too, and Josh Brown actually was talking about this on his podcast that I thought he touched on, is like, one of the things that they've been aiming for is to get Tesla in the S&P 500. And to do that, they had to have 4 consecutive quarters of profitability. So now they've had it, the 4 consecutive quarters of, now they haven't had they haven't had a fiscal year of profitability, but they've had 4 consecutive quarters. And so now it's kind of like, what's going to happen? And with that, all this stock-based compensation stuff is getting, released to Elon Musk. And it's crazy. The whole thing is just kind of nuts.
So it looks like, obviously that was short-lived, I think, and is very contingent on Tesla's volatile stock price, but pushing around a $71 billion net worth. I kind of went down the same path that you did, right? This was sort of the summation of growth versus value. I mean, Warren Buffett is arguably the greatest value investor in the history of our country.
Right.
And whether you love him, hate him, it doesn't matter. He's made an enormous fortune finding good companies to own or take big stakes in. And so Tesla's stock this year is up 238%. I checked this morning on YCharts. So Tesla up year to date 238%. BRK, so Berkshire, was down 14% on the year.
Oh, yeah, that's right.
And you're right.
Warren's lost it. He's lost his
So, but your theory is right. It's sort of, we're rewarding ideas and innovation over, let's say, profit and income, right? Substantial income. And Berkshire still makes substantial income, even though their stock price is not reflecting that. So I just thought, kind of perfect culmination of where we are in 2020.
Well, what I love, if you haven't heard before, Ross and I, we often call Buffett, we call him Uncle Warren, or at least I do. And, Uncle Warren, man, one of the things about him that people don't understand is how shrewd that man is. He's got this like delightful old grandpa demeanor, but that guy is sharp. And one of the things we got to give him some props, because early in this pandemic when the market was just going nuts. He was on the shows, Berkshire Letter was coming out. I mean, they had to cancel, I think, the Berkshire Hathaway event this year and do it virtually. And, he come out with his, don't bet against America stuff, which I always appreciate. But people were kind of giving him a hard time because normally this is the environment where you see Warren Buffett making some moves, right? And everyone was like, and he actually they sold all their airline stocks. And so people were like, uh-oh, Warren Buffett is selling. This is crazy. But a couple weeks later, what does he do? He takes a huge stake in Dominion Energy. So Warren Buffett's still in the game, folks. I mean, he may not be making the headlines that some of these high-flying companies and other, trading names are doing right now, but he's still in the game, and he's still looking to find what he believes are values. Like what Ross said, he's a different type of investor. He's looking for value.
Right. He's not sitting around the dinner table drinking Cokes and eating Blizzards from Dairy Queen. They're turning over every rock. They're looking for opportunities. They'll find them. Sure. I just thought that was just eye-opening, to see how much that's shifted in 2020. But that kind of leads me into the next topic I have for us today.
What you got?
So the NFL is around the corner, and as we know,
it's around the corner.
We think football is around the corner.
I'm getting tired of watching cornhole on ESPN.
Hey now, I love watching cornhole on ESPN. All right, so yeah, we're
one of us.
Football's around the corner, and it just highlights to me the culture we have building, or the culture that's sort of been created around gambling. Okay, so now this year we have DraftKings stock has kind of taken over and has had a really successful return this year in the marketplace. Mm-hmm. Gambling has become almost in many states, not all, but a lot of states have adopted sports gambling and are allowing companies like DraftKings to, through an application, just an app on your phone, be able to get access to lines. They make their own book and basically gamble on your phone on whatever sports are available. Right.
Right.
And I wanted to bring this up because there was an article that came through about Robinhood, and of course, Robinhood is the trading application, probably favored by younger traders. But it said, Robinhood has lured young traders sometimes with devastating results. This was a Times article, but basically it talks about its users buy and sell the riskiest financial products and do so more frequently than customers at other retail brokerage firms, but their inexperience can lead to staggering losses. And so what I really wanted to focus on today was just the shift in mindset. Is there a shift in mindset, generation over generation, about how we approach investing, particularly stock investing? In 2 or 3 generations ago, would we have seen this type of activity? Is there more of a gambling approach to investing in the sense that it's shorter term trades, riskier trades, more frequent trades? And is that going to have, what kind of effect do we think that might have on our younger investors?
Wow. I think I would say that I don't know that there's necessarily been a mentality shift. I think it's more publicized now because of just how quickly we have access to information and what everyone else is doing. Back in the 90s, people didn't really know what everyone else was doing, on like I would say like a cellular level, like we have now. I mean, there's how many different social media platforms, how many different information platforms, talking heads, blogs, articles, YouTube channels, TikTok. I mean, you name it. I mean, there's just information pouring at people every which way. But, go back to like the .com era. You go back to, that bubble. You go back to Bitcoin. Look at Bitcoin 2017. I mean, these bubbles, I think people, when they feel like there is something that they're missing out on, they just pile in. And a lot of people still view the stock market or investing as a way to just create like microwavable wealth. Like, hey, I'm going to take my, $5,000 that I've got my life savings. If you're a young person and you've been able to squirrel away a little bit of money, and I'm going to turn that into, whatever it is they're dreaming of. And like anything else, it just amplifies or has the ability, ease of use, accessibility. All of these things can amplify bad behavior, just like that we talk about them being positive things. Technological innovations, like, wow, you now have an app where you, instead of having to like go to the casino and get your cash out of the ATM and go get chipped up to go sit at a table and actually do the gambling, we've eliminated all of that. Now you can do it right from where your couch at home with an app. And like anything else, that's you're creating an entire new marketplace, and people are gonna get involved.
It's entirely accessible. It's at your fingertips. It's there 24/7. The what's scary, I guess scary to me. Look, I'm an old soul. You know this. We talk about this all the time, right? I'm the grumpy advisor. I'm old.
Get off my lawn.
Get off my lawn. So that's fine. That's my viewpoint. And
Sure.
And it's not that I'm criticizing the speed of what's happening here, but my view is it helpful? Because I look at, for example, in this article on the Times, it said the velocity of options trading at leading retail brokers. So this is just options contracts traded for every dollar in the average customer's account. Just to give you a perspective, so TD Ameritrade was 2,188. Okay, option contracts traded for every dollar. Robinhood was 25,840.
Right,
25,840. I want to read you this real quick. Okay.
All right.
This is from Robinhood's portal. It says commission-free options trading. Listen to this. Level up with options trading. It's quick, straightforward, and always commission-free. Is it straightforward? Is it, should it be quick? And,
No.
And the idea that you got to level up, like it's a game. This is my thing. Like they're building these algorithmic nudges where they're kind of encouraging you, right? You make a trade, emojis fall down the screen. There's a reward, right? You log into your account for the first time, they give you a stock. It's just like all these little pushes to get you moving.
Well, I can't remember who said it, but somebody put it, where Robinhood has, they've gamified trading in the stock market, where they are in a lot of ways divorcing the real life potential consequences of things going badly. It's like, this isn't Call of Duty, where you can turn the console off and just say, I'll play again tomorrow. This is like real money on the line. In fact, there was a story that was circulated through financial media not that long ago. It was actually during this pandemic where a young man took his life, like committed suicide because he had, I think had used like leverage on Robinhood and had done some trades, and he was using something. He was using some type of option. And the two sides of it, well, one side hadn't settled yet. So when he logged into his account, he saw like he was negative like $750,000. And he thought like his life was over. Like he owed like $750,000 and he committed suicide. And I mean, it was a big story that broke. Even it prompted, several news media outlets to write about it. Robinhood responded and talked about they needed to fix their algorithm. But, this is the kind of stuff that's happening. And I read somewhere, or someone, said this to me in a conversation, but the thing that everyone I think needs to understand about Wall Street specifically is there is a difference between traders and investors. And given all things being equal, Wall Street wants traders. They want the transactions. They want the activity. They want that churn to constantly be happening. So you're going to see these platforms where make it easy to trade. We're going to remove the friction. We're going to remove the fees. We're going to remove the barriers. You can do it on your phone. They want that. They want people in there, and they want moving, things moving, in and out, because people are just irrational beings, And if you have efficient markets, well, who is inefficient? People. So that's who we have to deal with. We have to make people inefficient, and that's how we can profit.
Well, and they're getting it because trading activity has been enormous. It's really exploded this year. So not even just across Robinhood's platform, but across all the major platforms, trading is up. And so you're right. So going back to the gentleman that took his life. So this young kid, his name was Alex. He was 20 years old. He was making some kind of credit or debit spread, most likely on options.
Right.
So he kind of bracketed his trade. It's not necessarily an outsized risk, and it wasn't necessarily an expensive trade. But when you multiply out, what happened was one side of that equation had sold, and the other side just hadn't sold yet.
Yeah.
If it would have synchronized, he probably would have seen a pretty small difference in his account balance. But because it wasn't synchronized and he didn't see that other positive side, he thought he lost $700,000, and he did it. And now this young man took his life. And we're in these waters where and part of me, I respect the young investors for their risk taking, just focus. Like they are not afraid to take risks on some level, right?
But I mean, you look at what's happening though. Like Hertz files bankruptcy, and then all of a sudden, their share price like goes up. But all these people pile into Hertz. It's just, I mean, it's great. I think that people are getting interested in investing at an earlier age. People are, it's like I said, accessibility is allowing people to, get involved in the market. That's a good thing. We want access. However, there's still a degree of just, inexperience and naivete and just behavioral bias and stuff that if you don't have the experience, you get thrown right into the shark tank. You're not the shark, you're the feeder fish. Right. And it's not that's not a negative thing, but there are people that you have to kind of have it handed to you a little bit before you respect the game. And I think that's what's lacking right now is there's not really a respect for the game, because especially with, this pandemic happening, the massive quick drawdown we had at the beginning of the year, then the markets really recovered spectacularly. I think we would all say like the recovery has been somewhat unexpected, and we're all kind of saying our prayers like, all right, we want this to hold and we want the regular economy to catch up. But your average investors, your new people that just got in, what's their experience been? Like, oh my gosh, like, Dave Portnoy, like the stocks only go up. Well, yeah, Dave, over like a 25-year time horizon. But if you start to shrink that down, I mean, it could get really hairy for people. And I that's what I fear, is that a lot of people are really out over their skis right now and they don't realize it.
Yeah. So something I was trying to find a little data on, and I just didn't find comfortable source, was I want to know or get a sense of how much of the account balances at some of these trading platforms are borrowed. How much of that money is borrowed either against credit card advances, home mortgage debt, actual margin accounts at the trading platforms? Because to me, one of the things that stuck out, so the New York Times wrote a story highlighting a gentleman's experience, right? So this guy's name was Richard, and he was a Navy medic in San Diego, right? Dabbled infrequently in stock trading. Well, he finds the Robinhood app. He goes in there. He funds his account with $15,000 in credit card advances, Michael, right? Then he goes in and borrows about $60,000 in additional home equity loans. Okay. So that's the story, right? So he borrows what? $75,000 against his equity and his credit. And listen to this. He actually grows his balance to $900,000 almost. And now but then loses it all.
Yeah, like, he can't take the win. That's the problem.
I don't understand.
He can't just take the win. That's one of those things we talk about. We use sports analogies a lot, and that's what I say is like one of the things in sports is you got to close, right? So a couple years ago, the Falcons were up. What were they? 28-3, 27-3 on the Patriots in the Super Bowl, and they didn't close it out, and they lost in spectacular fashion. And that's the same thing with investors. It's like you gotta have an idea of what your exit is. Like what's enough where you say, hey, if I hit this number, I don't care what happens, like I'm cashing out. And people, that is one of our biggest flaws is we can't take the win. We can't close it when
Right.
we've hit the grand slam and literally we're right there and all we got to do is finish. We can't finish. It's crazy.
So we have said and often say on our podcast that people say fear and greed drive the market. I think that's wrong. It's fear and fear.
Right.
It's fear of loss, but it's also fear of missing out. Right? It is, when do we just say, hey, wow, I made 6 figures trading and I'm a fairly novice trader. That's a very huge win. That could change my family's, financial trajectory.
Right.
But it can't just be that, right? We can't just make 7 or 8% a year. It's like this mindset is completely shifted where it's all or nothing. And personally, I feel like we've kind of lost whatever classic investment strategy, fundamental, even just kind of like we just talked about, the sense of value trade, like a value investing is just,
Well, one of the
completely.
things that can happen in environments like this is not all people, but some people start to look over the fence and they see what other people are doing and they see, oh, wow, they're having massive success, on paper, right? Because like we just said, most of these people don't cash out and take the winnings. They wait until it evaporates. But there's a big run up and someone, has done really well and they start looking at that. And the temptation is to pull off of your plan and say, all right, this isn't working for me. My balanced portfolio, with, a little bit of growth in there, it's not working. I'm not seeing the types of returns. I'm missing out on what the market is actually doing. And we're like, well, is this market a healthy market? Is this the rules of the road that we think we should be setting our sail by? Because I'm not really sure that this is the market that we need to be crafting all future investment policy around. I think this is just, we had a significant downturn. Rates went to zero. The Federal Reserve is pumping money. The government's pumping money. Should we be shifting our focus, or should we just be like steady to our preset course? And that's what I think bothers me the most when I see how some people talk about this environment, when they're talking about the traders and you're seeing how much money that, so-and-so's quote unquote making. And I'm like, no, let's see what they've lost. Let's see what their net gain looks like. It's easy to, pick one stock, did they, and do this for a couple of months. Let's do this for a few years and let's see how it plays out.
Okay. So our gambling culture marches forward, and
it's coming.
So we'll see if there's football to gamble on, but we know for one thing, there will be stocks to gamble on. All right, I had one more thing, and then I want to jump over to something you have today. So, saw an interesting post from Epsilon Theory. This is a group I follow. Oh, Ben Hunt. So
he's been salty lately, man. God, he's been salty for a few months.
I thought he made some one idea that I want to share, which is, this was an article, he titled it Snip. He said, this note is about the cutting of the cord between taxes and spending, which is pretty much the last thing that keeps us citizen astronauts tethered to the spaceship of non-totalitarian government. How about that? And in the note, so he basically has said that his idea is, taxation is just completely dislocated from spending, right? That the idea that we would have a balanced budget or tax to spend, meaning, we tax and collect money to then therefore use it to fund the government, is sort of just not there any longer, right? That tether has been cut. That he goes on to say, he says, so LOL, see, this is why you become a paid subscriber, whatever. Okay. More seriously, though, I want to leave you with this conclusion to snip. Once the tether between taxes and spending is cut, he says there are no limits to the retributive and malicious use of taxation as a political weapon, and there are no limits to the retributive and malicious use of spending as a political reward. So this isn't a Democratic thing, and it isn't a Republican thing, it's a power thing. So basically, we start taxing things or activities or behavior we don't like, start rewarding spending for activities, behavior that we do. On this a line of thinking of short-termism and sort of the gambling culture we have in the stock market, there was a story I saw come through MarketWatch just a couple months ago. This was back in March of 2020 that said there is a pay-as-you-go tax proposal for unrealized capital gains. So this idea is starting to be floated around that we may tax unrealized gains in securities. So, for example, you buy stock A for $5. You hold that stock through the end of the year, and it grows to $25. You have a $20 gain. Normally, you're not taxed on unrealized gains until you realize them and sell. And then depending on your holding period would determine what level of tax you pay. What do you think about this idea of taxing unrealized gains, but also just the myriad of ways that we can alter or disincentivize someone from being a great investor?
I think taxing unrealized gains is absolutely insane for a number of reasons. But, this idea that you're going to, force liquidate. I mean, basically, what are you going to do? I mean, you're going to force people to sell positions, sell investments. Well, how does that impact the companies themselves? How does that impact the economy? I mean, where's the incentive to, invest at all? I mean, you're just going to create churn, and what'll happen, I think, as a byproduct of that is, there are a lot of some entities that would really need investment. I mean, who's going to buy muni bonds? Who's going to buy muni bonds? Yes, your interest might be tax free, but if there's gain on them, you're going to have to sell those, sell something to pay taxes. It's somebody who just doesn't understand, how a significant portion of our economy works to propose something like that. And it sounds more like something that was written by a political pundit than somebody that actually understands economics. So I just dismiss them out of hand. To your bigger point about tax being used politically, etc., I think that you have to consider more importantly, like who we going to vote for, because I'm not trying to get political, but if it's going to go into this situation where whoever's got the power of the purse and the power of taxing, what do they stand for? What's the core of their philosophy? Because if they're going to weaponize economics against you, if you're a political enemy, that's pretty big, in my opinion. So
we often see ideas floated. It doesn't take hold immediately, right? Sometimes these take years. Like we just finally saw that, in this past year, at the end of 2019, the legislation that put to bed the stretch IRA for non-spousal beneficiaries, right? Mm-hmm. So now inherited IRA from a parent, let's say, has to be liquidated within 10 years. That's been discussed for quite a while, right? It takes a few years for some of these to take root. And if this is the kind of direction that we're going on taxing of investment income, it just promotes what I said in the prior conversation, which is we're disincentivizing what is traditionally believed to be, let's say, a beneficial way to invest, right? To hold for long-term gains, to try and find assets that in companies, in ownership in companies that you believe will be profitable and will have a higher return over time. And we start to abandon some of these long-term strategies. And if everything becomes a churn, what does that mean for our younger investors? Because I don't necessarily see this in our retiree generation, this fast acting, let's switch this up and change everything every few days. I don't really see that, but I do see it in the younger generations. And what does that mean long term?
Well, stuff like that, I immediately think that that'll never happen. And I shouldn't probably be that Pollyanna about it. But I mean, anything I think about, like how many wealthy people we have in our Congress and our Senate, like, I mean, unless they just can pass something egregious like that and exempt themselves, they're going to be held to that standard as well. And I just don't see them voting against their own self-interest in that way. Because this would impact, the wealthier Americans. The other thing I did see in this vein, it was shared. I did not read the article, but it was back to, kind of Elizabeth Warren's resurrection of an idea. I think she was the one who originally was proposing it, but the transactions tax on financial transactions. And, this was, I think, being proposed in New Jersey. I think it was a state level proposal.
Mm-hmm.
And, and I just think, I don't understand why they don't see this is a economic killer. It's if your economy, like New Jersey and New York, think of how many financial institutions are up there because of the hub that's New York City. You're gonna put a tax on them for every transaction that takes place. They're gonna run for the hills. It doesn't make sense to me. It doesn't.
Certainly the institutions that feel like they can. I read a really interesting article on that. So one of the challenges right now, as we know, is speed, right? The speed at which your trade gets to the exchange. From Michael Lewis's book related to high frequency trading, right?
These boys, right?
Yeah. There may be some connectivity to that area, because the further they go away, even if they lose a fraction of a second, could it alter or impact their ultimate return? I don't know. I came across that article that New York and New Jersey considering consider financial transaction taxes. It seems small on a per unit basis, a quarter of a cent, but then you compound that over the millions and millions of shares that are traded, and it explodes rather quickly.
Yeah, no question.
All right, what else did you have for us?
Well, the last thing, and this is probably more on brand for us, being retirement planning, but it was an article by Wealth Management just talking about, it said a wave of early retirement is upon us, and obviously with the pandemic, forcing businesses to close or shut down, their offices, pare down their workforce. We've had a lot of Americans, obviously record unemployment numbers. And this is something we've talked about in the past. You have people that are in their, late 50s, early 60s, and then we have an event like this happen where they are furloughed or they're laid off from work, and that's it. They just decide that they're done and they don't want to go back to the workforce anymore. One of the things that can happen a lot of times when you see a big market decline is people are forced to consider working longer or trying to go back into the workforce because their investments were hit so hard. Well, the market recovered, pretty significantly. So, this article just talks about, it says the evidence is already surfacing that this pandemic is producing a wave of early retirements. A report published recently by 3 economists found that among people who had left the labor force through early April, 60% said they were retired, up from 53% from January before the pandemic. The largest increase was people over 65, but nearly half of the group were 50 to 65. And so this just made me think about some of the topics we've talked about in the past, and we've talked about the early and unplanned retirement. where, your plan is I'm going to work till 70, or I'm going to work till full retirement age. And then there's a life event of some magnitude that happens, and you're out of there at 61 or out of there at 62, and you've lost, 5 to 8 years of high earning years, but also you've been forced into a situation where your retirement plan is pulled forward multiple years, which can have a significant impact. I mean, we talk to people about the benefits of delaying Social Security. Not too hard to delay Social Security if you're already 65, and we talk about delaying to 67 or 68, but really hard to think about delaying if you're 61 and you're thinking, well, I got to delay or defer Social Security for 8 or 9 years. And then, so how do you justify or juggle that? That's a big thing. And so I think this is going to be, a little bit of a math problem for a lot of people that are at that age where they know that they could possibly go either way, but they're not sure what to do, or they think, well, I'm just going to go ahead and retire, and they're going to do some things that I think may not be prudent because they just don't want to consider going back to the workforce. I don't know. What are your thoughts on that?
So we've watched, we've been able to kind of come alongside people through those final few years of their work life and see some of the immense benefits they can add to their long-term financial security by working a year or two longer than maybe they originally planned. And it doesn't seem like a lot in the big picture. If you think a 35, 40-year work history, and is the last 2 or 3 years going to have that much of an impact on me over the 20 to 30-year retirement I'm going to have? And in some cases, it's absolutely the case, because like you mentioned, if it's in your early 60s and let's say you're eligible for early Social Security, do you take it, or do you backstop that with your personal savings? Well, if the question is, can I backstop it with employment income? Well, then, that becomes a lot easier question, right? You can wait. You can defer that Social Security benefit. It becomes a little larger each month. There's so much high impact saving in the last 5 to 6 years of retirement, and there's so much high impact debt reduction. I don't think we realize how much those last few years can really help focus, because let's say this may be the first decade that you're not also supporting financially children, right? You're through the college years. Hopefully your children are on their feet financially. They're living on their own. They're making their own income. And now, for maybe the first time in your work career, you're focusing all of your savings on yourself, right? So maybe you've got a pecking order of debt obligations you want to have paid down. Maybe you have a goal of maximizing, retirement contributions through your employer, or you have cash savings goals, right? We talk a lot about tax diversification in retirement. So instead of maybe just building up these 401k balances, maybe we find ways to build cash, build a little bit more tax-friendly withdrawal. And to lose those last 2 to 5 years can have a really dramatic impact.
Yeah, no, I just think back on, some of the work that we've done over the years. And a lot of times, one of the things that we are constantly applauding people is when they come to begin working with us or begin working on their financial plan when they've got, 5, 6, 7 years before their actual planned retirement date, because they've given themselves a lot of runway to make course corrections, figure some things out, have some more in-depth conversations about what they want retirement to look like for them, the kind of life they want to have, where they want to live, instead of, folks that come in and they're like, hey, we're done in 6 months. The planning dynamic is very different in those engagements. And I always think about the folks that wait till the last moment to try to prepare. Like, if you had to do it over again, what benefits could you have given yourself if you'd given yourself a couple of years to adjust on a few things, focus on paying off credit card debt, really looking at, how you're going to do your income plan. And this is the type of event that happens where sometimes life happens to you. and you have to respond. And the people that don't already have a plan, now they're swept up in the urgency of the moment and all the emotions. And that's when I think we make the worst financial decisions, is when we're, when we got some type of urgency and we're highly, our emotions are just running crazy. So this is going to be interesting to see. And, the article gave a couple of things, but I'll close us off with this. And this is one of the things that it talks about. And we've mentioned this in our office as well. It talks about forecasting the market being a fool's errand. And one of the planners that was interviewed, Alan Roth, he said, most clients who come to him already have won the game, or they are winning it. And he says, so their need to take risk, when he means risk as in equity exposure, is low. He said, dying the richest person in the graveyard is not the goal. And, I think about a lot of the folks that we talk to, it's very similar. They're doing well. They're winning the game. They need some refining. They need maybe a little bit more clarity about their direction and how they want to structure their plan for themselves. But, they don't necessarily know how to do that. And so that's what the planning process is for. It helps them. But I also know, like, when we have this type of shock to the system, folks that have a plan in place, they tend to panic far less than the people who don't have a plan at all. That, it's kind of like, you're getting hit and you're like, now what do I do? Versus you're getting hit and like, well, we have a playbook. What does the playbook say?
Absolutely, Michael. It's a good way to end. It's a topsy-turvy year, but it's not this to be expected, and it's going to happen. And I think it's how we deal with it.
You would think after what we've been through already, we're like, okay, enough. Now we know. Nope, we're just getting warmed up. Opening act is done. Now it's time for the main event. So it's going to be crazy. But as always, thank you guys for listening. We hope that you enjoyed the content today. Find us on social media. Ross is on Twitter, Ross Marinell. So am I, Michael H. Baker. Let's connect. Give us some content to talk about on the Money Huddle. We appreciate getting emails from time to time from those who listen about ideas for us to share. Happy to discuss anything you guys throw our way. You can email us at themoneyhuddle@bcplanning.com. And as always, we will talk to you next time.